Hello, everyone, and welcome to today's webinar, Trends and Challenges in Digital Asset Custody Adoption. My name is Tova Dvorin, and I'll be your moderator. I'm the Content Marketing Manager here at Unbound Tech, and I'm excited to be hosting this session today. I'm pleased to introduce you to our speakers, Sal Ternullo and Professor Yehuda Lindell. One moment. Sal is the Director and Co-Lead of KPMG's Crypto Asset Services within the Blockchain Center of Excellence, and Yehuda is the CEO and co-founder of Unbound Tech. Now, before I hand over the mic to Sal, there's a few general announcements about this webinar and some housekeeping that you should be aware of throughout this presentation. First, today's webinar will be available on demand after the live session, and it's accessible using the same link you're doing now. So if you're on your lunch break, if you have a sudden interruption, no worries, you could always come back and review the material. Second, we've added the slide deck, KPMG's white paper on crypto custody, and our guide to challenges with adopting digital asset custody for traditional financial services. They're all available in the Attachments tab at the side of your player. And third, we'd love to hear from you during today's presentation. If you have feedback or a question for Sal or Yehuda, please send it through the Ask a Question tab at the bottom of your player. We'll be answering questions at the end of the session, and if we don't get to your question in today's webinar, don't worry, we will be following up with you after the screening. So, without further ado, let's talk about digital asset custody. Sal, over to you.
Thanks so much, Tova. Appreciate your kind introduction, and thank you to Professor Yehuda and the Unbound team for hosting me on the conversation today. As Tova mentioned, I'm fortunate to co-lead KPMG's Crypto Asset Services in the U.S., where we support and deliver a full suite of services and capabilities for emerging technologies, specifically focusing with regards to crypto and digital assets. We've been active in the market in kind of the professional services space around crypto since 2015, working with some of the first mover exchanges in the space, and as a result have a differentiated body of experience understanding kind of crypto native operations and infrastructure. In 2020, we're driving institutionalization by supporting market delivery of robust and mature third-party custody products to large financial institutions and supporting their system integration in the development of robust crypto asset risk and security compliance programs related to and integrated with the core capability of custody. I'm excited to be here with Unbound today talking about trends and challenges with crypto custody and wanted to give a little bit of perspective in terms of why I'm here with you and how my journey led to this discussion. So I started my career in 2015 at State Street in technology audit within the third line of the bank, looking at middle and back office applications and infrastructure. In parallel to the start of my career, I continued feeding an obsession with crypto that spawned in kind of my college years from 2012 to 2013. The immediate and dramatic transformation of the custody capability was clear to me as I explored kind of the depths of self-custody, learning the unique risks of crypto firsthand when I lost my Ledger Nano early in 2016. But that really kind of gave me an appreciation and a respect for this emerging technology of blockchain. And my passion for the tech kind of pivoted me from audit to look at emerging technology within State Street and to assess the risks related to these emerging technologies, both within the macro context of our business, but also with regards to specific applications of each technology, whether that be robotics, blockchain, or AI. In this role, in the third line of defense emerging technologies advisory capacity, I worked closely for the head of technology audit, Art Ackerman, and Chandran Subramaniam, as well as a close friend, Ramesh Nagappan. And one of the core questions that we ultimately aim to solve is what led me to the discussion today, and that is, how do you audit a blockchain? We rapidly began solving for permission blockchains by building foundational tooling that drove audit analytics and continuous control monitoring of State Street's implementations on top of Fabric.7 at the time. In parallel, but with kind of a more tangential focus, we were looking at the mechanics of permissionless blockchains and building frameworks and perspectives on kind of the unique risk characteristics around assets on those chains. Some of that research was ultimately debuted through the Chamber of Digital Commerce in a paper called Advancing Cybersecurity in the Token Economy. But the most compelling findings that came out of the research focused on, first, the security models enforced by proof-of-work incentive systems, so looking at layer 1 protocol security, And the second looking at endpoints and custody mechanisms used to manage, control, and interact with the assets that were driving the network incentive systems. So while the importance of the first finding continues to be reinforced by leading research in the market today from organizations like MIT and the Digital Currency Initiative under Neha Narula, it was immediately clear that the second component around custody was of critical importance to State Street's business. So we dove deep into that custody question, being led by Ramesh, who was drawing on his experience hosting and securing government infrastructure in both AWS and Azure against FIPS, Federal Information Processing Standards. Ramesh was kind of our guru and our leader as we dove into the depths of cryptography. And ultimately, the results of our market analysis and research endeavors painted a compelling viewpoint that the Internet of Value, this era of Web 3.0, would require customized and Marvel mechanisms for cryptographic key management to guarantee security, resiliency, and also to build compliance programs that were specifically slated or designed around these assets. So this hypothesis of kind of this dynamic of transformation around institutional crypto custody was quickly reinforced at Consensus in 2017 with the emergence of a vibrant discussion around crypto custody. That was the year that Ledger Vault came and had a focus on the launch of their product offering. The discussion from a number of different institutions in the space was saying, we're coming, but we're waiting for custody. So the mania that ensued through that 2017 into 2018 timeframe really started to drive transformation across the crypto custody landscape. And we started to see an accelerated product development timeline where licensed custodians and institutions and payment providers were rapidly expanding their ability to engage in digital assets, beginning with custody. So looking at kind of where we stand today and looking forward through 2020, we see a realization that advances on Layer 1 protocols will enable greater scalability and privacy across the networks. We see increasing adoption with proof-of-stake networks and other types of consensus mechanisms, and further development of interoperability protocols, things that are looking to solve for kind of cross-network integration. Institutionalization in 2020 has really continued with more established financial institutions moving into the market, and with first movers taking bold and strategic pivots on the back of custody infrastructure to pivot new revenue verticals. The institutional adoption of these capabilities is being accelerated by partnerships with service providers like KPMG, who are delivering secure and compliant system integration and unlocking net new digital capabilities for traditional financial institutions. So around the custody capability, exciting companies are solving data challenges and providing enterprise-grade data infrastructure to support institutional engagement around that custody component. And finally, institutional insurers are better understanding and assessing the risk profile of custody infrastructure, which has been evidenced through an expansion in policy maximums as well as the nature of coverage through insurance policies. Looking at the third pillar or second pillar with regards to regulatory clarity, the regulators around the world continue to grapple with unique risk considerations around crypto and digital assets with kind of a varying approach. Some progressing, very forward-looking regulatory structures that, seek to provide clarity and attract crypto businesses, while other regulators are taking an opposite approach and kind of restricting access to these networks and pursuing enforcement actions against entities that are engaging in crypto. On a global scale, though, we're starting to see some regulatory harmonization around the implementation of FATF guidelines, Financial Action Task Force guidelines for crypto, specifically with regards to AML and Bank Secrecy Act compliance. But ultimately, these discussions have spurred exceptional conversation around the development of technical solutions that may support compliance with established financial services regulatory requirements. So we see the global regulatory environment continuing to evolve more quickly, driven by financial product innovation through stablecoin projects like Libra. Similarly to regulators, central banks have accelerated their approach in the space, aiming to release digital currencies in a number of different regions, including Sweden and China. Finally, companies' innovation in decentralized finance applications leveraging smart contract technology are transforming lending markets and unlocking Marvel C2C business models. across all these 4 pillars that I just framed, across all the trends that we're seeing in 2020, there is one core capability, and that capability is custody. Custody is the anchor of trust in crypto, and it is a critical foundation for institutionalization. The technical mechanics of custody for cryptographic key material is transforming, and so are the business processes across the middle and back office functions that integrate with this capability. Those functions include transaction processing, fund administration, and then your traditional enterprise functions including risk, security, compliance, and audit. Furthermore, and excitingly, custody is a foundation for new service verticals and new revenue opportunities for asset administrators to actually drive returns to asset owners. These systems and these types of services today are largely limited to the idea of institutional staking as a service, but they ultimately pose exciting and interesting questions around fiduciary responsibility and also taxation of earnings from staking systems. So while nascent in state on a relative basis to broader cryptographic mechanisms, innovation in MPC-based custody infrastructure and middleware technologies built on MPC are transforming the possibilities for trusted decentralized financial products and applications in both retail and institutional markets. When we look at institutional-grade custody solutions, we see 4 core building blocks: next-generation security and resilience, comprehensive compliance, third-party trust, and value-added custody. Starting with the first pillar here, next-generation security and resiliency speaks to designing enhanced security operations and controls which are aligned to the risk profile of the crypto asset under question. And again, this risk profile is fundamentally different from traditional assets. For crypto assets which are native to permissionless blockchains, protection and safekeeping is paramount because in the event of a compromise, there is no central authority to pursue asset recovery. In this context, the finality condition of transactions executed on public blockchains enhances the risk profile of the asset and stresses the importance of building layered preventative controls using leading cryptographic techniques for security across custody processes, applications, and infrastructure. Crypto regulation can often be cost-intensive and cumbersome if not navigated effectively, and the development of a robust, unified compliance program built on efficient processes and automation can help reduce the cost of compliance while providing transparency to support regulators and other stakeholders for the organization. Regulatory structures and environments continue to evolve, creating economic arbitrage opportunities, which are requiring companies to really remain diligent in monitoring global changes in the regulatory environment. In an effort to help shape policy which supports innovation while protecting market integrity, leading custodians in the U.S. market are actively engaged in education campaigns with policymakers to help them understand the emerging crypto economy and to foster regulation, to form regulation that really supports innovation. The third pillar of this 4-pillar model looks at third-party trust, which is an element of winning custody models that will continue to become increasingly more important as institutions continue to engage in the space. Validation of control design and effectiveness across financial reporting processes and custody technology infrastructure are of critical importance to asset owners who are trying to understand the risk exposure of their counterparties. Furthermore, the integration of established standards and evolving security best practices will build trust with customers that is required for mass adoption and ubiquitous utilization of crypto and digital assets. Finally, the concept of value-added custody centers on the development of a robust strategy that integrates new or existing front, middle, and back office functions around custody capabilities that enable access to new service verticals like staking, as I previously mentioned. So as these networks are evolving constantly and governance protocols are proving critical mechanisms for advancing DeFi applications, there will be a keen focus on always remaining on the edge of the market and staying aligned to these evolving technical changes and then capitalizing on new product and service opportunities. Before I hand it over to Yehuda, I wanted to share a graphic breaking down crypto custody to provide a perspective on how we view the capability model across entities and technologies. This graphic is central to a white paper we launched yesterday called Cracking Crypto Custody. I believe Tova was kind enough to link the paper to the deck, so you guys should have access to that paper as well. And while this diagram is a representation, technology innovation across the space continues rapidly and blurs the lines, boxes, and technology domains. We expect them to continue to shift. Most notably across this landscape, we've seen an accelerated adoption of multi-party computation-based wallet infrastructure. Similar to custody, but even more so as an emerging technology, there is a high degree of importance for third-party trust to be established in underlying cryptographic mechanisms through scientific and academic analysis, review, and reporting. This element of third-party trust driving the efficacy and integrity of Unbound's MPC technology has driven meaningful strides in the market, proving the critical importance of this technology within the institutional custody landscape. Furthermore, dynamic deployment models and integrations allow MPC models to be architected into systems which leverage traditional hardware HSM-based models, but also advance security availability dynamic. We look forward to later this year as Unbound continues to expand capabilities and deploying the ability to perform offline transaction signing using trusted MPC. Crypto custody will continue to be an amazing area of technology innovation, and I look forward to seeing the institutional bloom over the next few years. With that, I'll hand it off to Yehuda to take us through Unbound Tech and their MPC solution for crypto custody, CASP, the Crypto Asset Security Platform.
So, Sal, thank you very much for that. As you outlined the different pillars that are needed for a custody solution, I'll focus, of course, on the security pillar and talk about what are the different and unique aspects of security that are needed in this space and what value can be provided through MPC solutions and in comparison to others as well. One of the first things that we have to do when we look at this space is understand why it differs to other types of security in other settings, both cryptographic and obviously physical as well. First and foremost, the asset here is obviously a digital asset, and the asset itself actually is equivalent to the cryptographic key that protects that asset. So in all of these digital assets, it's a cryptographic signing key. And that signing key is used to perform a transaction, and therefore, if you have control over that key, you actually own the asset entirely. It's obviously a purely digital asset in that sense. What that means is that if you want to steal the asset, obviously you can steal the key, but something that is a little bit different here to the normal setting is that you don't actually have to steal the key to steal the asset. You just have to fraudulently use it just once. So if I'm able to perform a transaction, a fraudulent transaction to transfer all of the funds protected by a specific key, then I've stolen all of the money, and there's no need whatsoever for me to actually take the key itself. We compare that to the standard cryptographic key protection scenario. Let's say I have a database of encrypted credit cards. I might have 1 million credit cards encrypted in the database. If someone's able to steal the key and steal the encrypted database, then they just go home and decrypt it all, and that's what actually happens in a large majority of these breaches. But if the person, the attacker here, only has access to use the key fraudulently, then I'll have to somehow access the system to decrypt credit cards one at a time, and pretty quickly, anomaly detection and other types of policy checks or rate limiting can prevent the continued decryption. So out of 1 million, they may get 10,000 credit card numbers. There's certainly damage there, but the difference is huge, as I'm sure you can all appreciate. In this scenario, it's a very different scenario because you only need to carry out one transaction and you can transfer all the funds. Even if there's $1 billion worth of funds protected by that key, I only need to use it once. And that means that we're not protecting, it's not enough to protect against theft. We have to prevent against fraudulent key usage. And the third unique point is one that Sal mentioned, which is that the decentralized nature of these assets means that you can't rewind a transaction that took place. Once the money has been transferred, the game is over, and there's just nothing that you can do about it whatsoever. And that means that we can't afford to say that, okay, so sometimes things can go bad and we'll be able to recover from them later on. No, in this game, there is absolutely no way to recover. And the combination of these three elements makes key protection in the context of digital asset security and cryptocurrency security a very unique challenge. So what are the different scenarios that we're looking at? Really what I want to say in this slide is simply that there is a very large range of possible scenarios where we want to protect digital assets and cryptographic keys relating to those assets. And they go from custody through exchanges and to wallets. And indeed, we're focusing in this webinar on the custody scenario, but it's worth noting that the basic underlying technology is relevant for all of them. In a custody solution, often we're talking about very large amounts of assets. There can be a small turnover. So complex transactions are actually acceptable. And if actually what we often want to do in the digital asset world is to replicate the types of processes and protections that exist in physical custody today and replicate that to the digital world. Why do we want to do that? Well, often there's a good reason why that's there. There's a good reason why we have built up those all of those protections over the years and those processes. And secondly, regulators understand those processes, and we want to try to often speak in a language that they'll understand so that we can get them to get on board and accept this new type of asset and way of working. Exchanges have a slightly different scenario in the sense they often have high turnover and they need very high speed for the transactions. But it's important to note that in a custody scenario, although you often don't have high turnover, you do need to be able to provide fast response. So if someone wants to get their funds out quickly, they can do that. Wallets is typically for end users, small amounts of funds, and what we're going to talk about here is less relevant to there, but the same underlying technology works as well. What do we want from a platform that provides security? And it's important for me to stress that we're really talking about a solution platform, not something which provides a specific cryptographic component, but we need something which is much, much more broad in order to give strong protection for the entire process. So number one is, of course, high security, and that's an obvious one. But again, I want to stress that it's not just protection against key theft, but also fraudulent key usage. Fast transaction speed for the reason that I mentioned. If you're an exchange, then you'll need to provide service quickly because people want to trade often. It's not just for exchanges, it's for other scenarios as well. And in the custody setting, again, when someone wants to get their assets out quickly, we need to be able to have a platform that enables that to happen. And the next four elements are sometimes overlooked at first sight when you think about what you need for a solution. A very, very important one is flexibility. And that's because this space is moving so fast, it's very unclear what we're actually going to be trading in 2 years. Sal talked about proofs of stake, which are now growing in popularity. There are a lot of good reasons for that. We're not there yet. It's unclear also what type of assets will be, what proof of stake protocol we'll be using. In fact, likely we'll be using multiple of those, also proof of work. We want to be able to have some infrastructure that is ledger agnostic. It doesn't matter what coin I'm using. It doesn't matter what consensus protocol I'm using. It doesn't even matter if it's a permissioned or permissionless blockchain. We're protecting the signing process, which actually is the same across all of these platforms. It's not exactly the same. They sometimes have different signing algorithms, maybe it's ECDSA or Schnorr or EDDSA, but it's the same underlying concept. We want something that will be able to work with all of these different coins. We also want to, and ledgers, and we also want to be able to fine-tune security versus usability in the same type of solution. And that's because Very often there are different sizes of wallets and vaults, and you want to be able to enable small transactions very easily, but larger transactions should have a more complex process. And again, we wouldn't want to have different platforms for different sizes of wallets and for different needs. That becomes cumbersome and very undesirable. The next one is backup and disaster recovery. Again, because the key is the asset, if you lose the key, those funds now just remain in limbo for eternity. There is no one that can actually access them. And we know, we've heard the stories of the person who mined Bitcoin in grad school and then threw out their hard drive because they thought nothing was going to happen with it. More recently, we've heard of CEOs maybe disappearing, maybe dying, nobody knows, but lots of funds may be limbo or maybe not. And again, if we're a custody solution and keys are somehow lost because of some disaster, that obviously is something that is just unacceptable. Integrated risk-based policy enforcement. This relates to regulatory compliance, but also for providing a broader security solution. It's not just protecting the key and making sure that somebody approves the operation. We also want to verify whether that operation makes sense at this time, whether we allow that type of operation over the weekend or at night, or maybe we want to have whitelists, and I'll talk more about this later on. We want to enable custodians and their customers to define policies around when transactions can take place, and we want all of this to be cryptographically enforced. And finally, for compliance, separation of roles and other things that are related to administration versus users, and possibly splitting separation of multiple roles. So what are the different solutions that are out there? One is a cold wallet or disconnected hardware solution. Here I have the key maybe on a USB stick. This sits in a vault that needs 3 people to come and type in their PIN or maybe their biometric to open the physical vault. Then they come inside, connect the USB drive to a computer. There's a computer inside the vault with the key inside. The USB drive has the transaction information. I connect that. The transaction is carried out. The signing is carried out back onto the USB drive, and I take that out of the vault and lock it up again. Incredibly poor usability, not just in terms of the long transaction time, which is about our customers, also about our employees. You're either going to have to put up with a very, very poor SLA if someone wants to make a transaction late Friday afternoon or possibly before a holiday. Employees are going to have to come in the weekend, at night. I also want to say that a lot of people in the industry think that, okay, if it's cold and disconnected, then it's secure. This is sort of the overall or the overriding philosophy or belief. I'm not that convinced. I think doing cold very well is also challenging. For example, this type of setup where I have a computer, maybe even an HSM, a very well-secured computer, inside a disconnected vault, and I come and put a USB drive in. Well, who says that USB drive doesn't have malware on it? And we know that there are supply chain attacks where you go and you actually install malware on the USB drive already at the factory where it's manufactured, or in other ways. It's not that easy to do this so well. And at the end, there's also the key is in one single place. It is a single point of failure. I'm not saying that this is a bad solution at all. I'm just saying that it's not a perfect solution, and doing it well is also very challenging. Beyond that, though, it's very inflexible and has very poor usability. HSMs, hardware security modules, are great for protecting keys from being stolen. Again, they're not perfect. If you had seen the presentation by Ledger at Black Hat in 2019, Black Hat USA 2019, the HSM is also, it's all about physical security, but the software, if the software isn't secure, you can carry out a remote attack. I actually believe the HSMs are just the wrong technology for the problem we're trying to solve, because HSMs are designed to prevent key theft. And as I mentioned earlier, the problem we're looking at here is fraudulent key usage. If somebody has access to the machine that is allowed to ask the HSM to carry out a transaction, we really don't care if they can extract the key. They can just carry out the transaction and steal all of the funds. And here we have sort of like, either the HSM is disconnected, and then it's the same as the previous item with cold wallets. It's in a vault. You have the poor usability and all the other problems, and or it's connected to the internet. If it's connected to the internet, the fact that you can't extract the key from it doesn't really matter, and you haven't really done very much. So although HSMs may provide an additional layer around this cold type of solution, it's not really solving the problem that we need to solve here. Multi-sig is a solution paradigm which is supported by some ledgers and some coins. And what it says is that you can define, instead of having one key to carry out a transaction, you can define maybe three public keys, three signing keys, and the blockchain or the ledger understands that the transaction will only take place if 2 out of 3 of those keys are used to sign. Sort of like the standard idea where you have 3 signatories, and for a large check, you need 2 people to sign on the check. This now removes that single point of failure. There isn't a single key. You now have to obtain 2 keys. The problem with multi-sig is it's not supported by all ledgers, so it doesn't work with the ledger agnostic concept that I talked about and the flexibility. You should be able to work with everything. Even when it does work, like so in Bitcoin, it's built in. In Ethereum, you can program a multi-sig because the Ethereum smart contract language can actually do anything. But that's also a danger of the Ethereum smart contract language. And in fact, writing such multi-sig scripts in Ethereum in itself opens up a different type and a new type of attack. So it's not always desired. And there are other ledgers that just don't support multi-sig at all. It also comes at a cost. Using multi-sig actually costs a higher transaction fee, and it has limited capabilities in the size of the quorum and the type of quorum that you can support. Another really important element, which is crucial when you're thinking about not an end user wallet. Multi-sigs were actually, to the best of my understanding, introduced with an end user in mind, with their end user wallet. That's very different from an exchange or a custody where we're talking about employees, and employees come and go. And let's think about what happens if we have a few keys spread amongst employees and an employee leaves. Then if that employee had access to that key or could have extracted that key, then we now actually have to transfer the funds in order to prevent an employee who's left the company from still being able to carry the transaction. And that's obviously extremely painful, so therefore we need to find ways that an employee has access to the key but can't extract it and can take it away, maybe with a smart card or something like that. It starts becoming complex. But what happens if an employee joins the team? So let's say until now we had 2 out of 3 people in the executive team need to sign this type of transaction, and now we want to make it 2 out of 4. Once again, we'd actually have to transfer all of those funds on the blockchain in order to enable that type of change. Multisig just doesn't support this sort of institutional type of setting on an organizational scale. It also doesn't support something called refresh, which in my mind is a very important security property. And that is, let's say again, we have 3 keys and you need 2 of them to sign. It may take the attacker a long time, especially if you think of a custody setting. That key can be valid for a very, very long time. And it may take maybe the attacker will steal 1 key and it will take them 5 months to steal another key. So they'll breach my machine, and then 5 months later someone else's. They've got the 2 keys, they can carry out the operation. What we'd really like is to force the attacker to actually breach both machines or have access simultaneously to both keys in order to carry out an operation. That makes it much, much harder for the attacker. Of course, I just want to stress there is no 100% security in the world, not in the physical world and on the digital world. but we want to make it much, much harder and almost impossible for the attacker to carry it out, although there's no impossible, but we want to make it very, very hard. Finally, there is SGX. SGX and other secure enclaves. Secure enclaves are physical or physical or in firmware regions where you can run code securely, and it cannot be tampered with, and it has full memory encryption and so on and so forth. Intel SGX is the most common example of this. The problem is it just isn't secure. Cryptographic keys can be extracted. There is a lack of isolation. I won't go into all the details, but I can say that the attestation key used in SGX by Intel, that's the most valuable key. That itself is an ECDSA key, the same type of signing key used in Bitcoin, for example. That actually has been extracted from SGX enclaves because these enclaves are not purely isolated computing environments. I won't talk about it more. I'll just say that unfortunately these have proven themselves to be very good only as a secondary security measure. As a primary security measure, they're just not strong enough. So yeah, if you want to do something else and then run inside SGX to make it even harder for the attacker to do something, then they're good. They're certainly good for that, but nothing beyond that. What is MPC or secure multi-party computation? This is an area of cryptography, a subfield of cryptography. It began in the mid to late 80s. It was pure theory for a very long time. I started studying MPC in 1998. So when Sal mentioned, I think, being in his undergrad in 2011-12, I started really thinking about my white hair because that made me feel very, very old. I started doing MPC research in 98. And again, for a good decade, really understanding the scientific foundations, what can be done, how it can be done. And the idea of MPC is how to compute on data without revealing anything. So you can have data in different places, belonging to different parties, and you can do a computation without revealing that data to each other. There have been thousands of academic papers written about MPC, from the theoretical foundations to applied practical solutions. It's a very active applied area of research today. And now what we're seeing even more than that is its transition into commercial solutions, both in the cryptocurrency and digital asset space, and also in other areas of enterprise security. An important thing about MPC, before I go into how it's applied here, is that it's really science. So when people ask me in the startup world, people often ask, what's your secret sauce or what's the magic? And I always like to answer, we don't have any secret sauce or magic, we have science. And MPC solutions have mathematically proven guarantees. All of the protocols that should be in use any vendor who provides an MPC solution should promote transparency. So these are software-only solutions that can be reviewed. The solutions should be peer-reviewed and be available for public inspection. And this is what we at Unbound very much believe in with our solutions. So without further ado, I'll explain what actually MPC does in the cryptocurrency world. And this can be called threshold signatures or MPC signatures. It's essentially the same idea. The idea is instead of holding a key, and here we're talking about a single standard signature, so there's just one key, and we want to prevent that key from being stolen or used by an attacker in a fraudulent way. Instead of putting the key on one machine and trying to protect that machine, so, really trying to build a very secure virtual vault, which is essentially an impossible task, we actually split up the key into random shares, or sometimes called shards, and put those on different machines and different devices. And the important property of this division is that if you only get to a subset of the key shares, you actually can learn nothing whatsoever about the key. So each subset looks just like completely random garbage and means says nothing whatsoever about the key, and you can only know anything if you see all pieces. It's like if the key was, a number, 78, we could write down random numbers that sum to 78, and unless you got all of those numbers, you wouldn't know anything. So if I gave you 22 and 30, it would mean nothing. It's 52. Then the additional number could be anything, but then you would have to see the additional 26, and then you'd be able to, it would sum to 78. Obviously, it's more complex than that, but that's the basic idea. What's novel and crucial to the notion of MPC is that these key shares are never combined, even when you carry out the signing operation itself. So often people think about the secret sharing idea. Okay, we have the key split into random shares all around, but when we want to actually carry an operation, we then bring it together momentarily, carry out the signing, and then throw them away. No, we actually never bring them together, because ever bringing them together means that we now have this, again, single point of failure where someone can be on that machine waiting patiently, and when the shares are recombined, they can actually steal the key. So MPC is all about, as I mentioned, computing on data without ever bringing it together and without revealing it. In the case of threshold signatures, the data is actually the key shares, and they're never ever brought together. In order to breach, you would need to actually compromise multiple parties simultaneously, because it has to be, this sharing is continually refreshed and modified. So you actually have to get to all of those machines at the same time. And as I mentioned, it has mathematically proven security. Another very important point about these MPC solutions is that the key sharing can actually be very sophisticated. So it could be, yeah, I'm splitting the key into 5 places, and you need to breach all 5. We can also do much more sophisticated things like define what we call flexible quorum structure. So a basic quorum structure is to say that, okay, we have a set of 7 people, and 5 out of those 7 need to approve the transaction in order for it to be carried out. Again, that 5 out of 7 is cryptographically enforced. You would need to breach 5 machines to cheat, and any 5 machines can legitimately carry out the operation. We can go much further than that. We could even say, okay, there are 2 sets of parties. You need 5 out of 7 in the first set and 2 out of 3 in the 7th set. But you can go beyond 2 sets. It can be any number. You could think of even a custodian who has a set at the custodian, and there's another set at the client, and maybe even a 3rd set at the trustee, at a third party trustee, if you need, if you want such an elaborate setup. And here's also what I talked about earlier, being able to tailor the security of the solution, the usability, depending on what you're protecting. If it's a small wallet with small amounts of funds, you can define a small, simple quorums. And if it's a larger wallet or larger vault, you can define a more complex quorum. And the quorum can contain parties from different organizations or from the same organization, or possibly different teams in an organization. And it can even depend on other policies. So if it's a very large transaction, you need a larger quorum, and a smaller transaction uses a smaller quorum. All of this is possible, and these devices can be automatic bots on servers. They can be humans who receive a request to their phone. They can even be a disconnected device, as I'll talk a bit more later on. Interesting element about this as well is that it supports this employee replacement and change, because MPC has that flexibility. If we have a quorum of 3 out of 5, we can change that to 3 out of 6 without any problem whatsoever if someone joins the group. And we can also revoke the share of an employee who leaves the company. So it supports this type of institutional environment that I was talking about earlier. Offline party, as I mentioned, sometimes regulators may require that we don't want the full key to be, even in pieces, to be available online. We can connect one of those pieces to be an offline element, and therefore meet the regulatory compliance. And you may say, well, if I'm doing that, then why bother? Why not just have a standard old school cold wallet solution? And my answer to that is that, as I mentioned before, a standard cold solution is not so simple, and is still a single point of failure. And secondly, once you're doing it in this way, maybe you don't need such an elaborate system for 3 people coming to a physical vault because there's only one piece, and you can actually support better processes. Just a couple more points before I finish. We can support also, again, with the same cryptographic enforcement across all of these participants, risk-based policies. So you can define that depending on the transaction amount, the time of day, the day of the week, maybe a list of whitelists, whether a certain transaction of a certain size is allowed or not allowed, or what the size of the quorum is that is needed for that transaction. This starts now looking more like the things that we're used to in the standard custody scenario. We can also define a quorum of administrators to manage the policies, which is very important for the separation of roles. And these policies are validated at all of the sites by every party who holds a key share, ensuring that it cannot be bypassed. So this is not a security solution where everyone sort of just tells they're okay to a central server who carries out the operation, because you can just bypass all of the protections by going directly to that central server. There is no central server here, and everything is verified in a distributed way, which also goes together very nicely with the whole distributed philosophy of these digital assets. As I mentioned, the transaction approval can be optimized for speed and for security, depending. So humans who would hold a share on their mobile phone, for example, this share is protected using additional means with additional NPC that I won't go into, but they'll receive a request to sign. They'll verify the policy. The policy will be automatically verified. Only if it passes that, they'll be presented the transaction. They'll verify that it makes sense. Maybe make a phone call if it's something that seems to them to be very large or very extraordinary. They'll then approve if there's a secure enclave or Touch ID, for example, on their phone. That will be utilized as well. And the phone itself actually participates in the MPC protocol running the cryptographic protocol, and therefore ensuring enforcement at each endpoint itself. In summary, threshold signing and MPC provides as the slide says, really a comprehensive platform. It's not a pointed solution for a specific problem. It's something that enables us to really get a very broad, security solution, going from the key protection, obviously, all the way through to preventing fraudulent key usage by enabling quorum definitions and policy-based, risk-based policy enforcement. Can also be AML or KYC and all of these other types of policies that we're used to. There's no single point of compromise because the key is never ever brought together. It's suitable for the entire spectrum of cryptocurrency and digital asset security, and because it's ledger agnostic, and because it's independent of the type of asset itself, it's something that has the flexibility that you need today, and also going forward, wherever the market goes, you know that your custody solution can actually adapt very easily. It also enables asynchronous approval transactions. So, you know, if you have 5 out of 7 humans who need to approve, they can one at a time, and as soon as 5 have approved, it goes through. Compliance, as I mentioned before, because there's no single party with access to the key, and because we can integrate policy enforcement and offline, this is something that works together well with the way regulators are looking at this space right now. So that's what I have to say, and I guess that we can go to questions.
Okay, great. Thank you so much, Sal and Yehuda, for presenting today. Let's move over to Q&A. Just before we begin, because I see we are running short on time, just a reminder that we will respond to all the questions you've submitted. So feel free to keep submitting. Even if we don't get to your question on air, at the very least, we will make sure to follow up with you within the next 48 to 72 hours. And without further ado, first question, Sal, do you think regulation as a brokerage company would be required to provide custodial services to the banks regarding crypto assets would be necessary in the nearest future?
Yeah, so that's a great question, and I think it's kind of hitting on several current regulatory events and ongoing advances of legislation that will play out. So, there's advancing regulation in Wyoming that is looking at kind of the speedy bank process to provide limited purpose custodial banking charters. Obviously, we see established state-level legislation like the BitLicense program elsewhere, but I think it's going to evolve on a state-by-state basis until we have some unified approach from a federal perspective, which does not seem to be, in my mind, in the next 12 to 18 months. I think most folks would agree.
Okay. Thanks, Sal. Yehuda, do you have anything else to weigh in on that?
No, I think Sal is the expert on that side of things.
Okay, great. So the next question is for you then. Yehuda, running part of this using approvals and signing via mobile devices leaves that aspect vulnerable to SIM swapping. How do you mitigate against this potential attack vector?
Okay, so before I answer specifically the question, I want to stress that we provide a generic platform that can be deployed by our customers in any way that they want to. So the key shares can be on mobile devices, they can be on laptops, they can be on servers in our customers' data centers or in different clouds. So we actually we provide a solution that really has flexibility. I do believe actually that the mobile solution is a good one for, in many cases, for employees. And it's actually not vulnerable to SIM swapping, because what SIM swapping enables you to do is to identify yourself as someone else's phone. And that's great when a one-time password is, for example, being sent, because now you reroute that essentially to your phone. But in our solution, the user's mobile phone actually holds cryptographic material that is essential to the transaction. Without that cryptographic material, you can't even carry out the transaction. And that cryptographic material is, again, further protected using other methods. And typically, we require the user to use a biometric or a PIN or something like that to authenticate to a remote server before being able to unlock even their share of the key on their device. So it's not vulnerable at all to SIM swapping, and has you actually would need to clone the user's phone, and even then you would not be able to bypass things like the user's password, or the if it's a Touch ID, you would have to clone the secure enclave, which is much more difficult. So all of this, and even if you did all of that, you would still be only getting one share out of the multiple.
Okay, thanks for that, Yehuda. Sal, another one for you. What trends do you anticipate across the institutional custody landscape in 2020 and then throughout 2021?
Another great question. Thanks, Tova. So as 2020 continues to kind of evolve, we expect to see a number of the first mover institutions kind of optimize and uplift their existing infrastructure and back end. We saw a lot of folks building through the 2015, 16, 17 timeframe, and those builds internally were, fit for purpose to a certain use case and certain scale. As those organizations are breaking through the boundaries of their business requirements, they're looking towards optimization through the implementation of third-party technologies like Unbound to either optimize the performance of their infrastructure or advance the security model. So we expect to see that continue through 2020. 2021, we hope will be an exciting year, predicated on, again, enhanced regulatory clarity, looking towards the end of 2021. And then hopefully as well, the emergence of more structured perspectives globally, both with regards to compliance expectations for anti-money laundering, but also more broadly with regards to the previous question that was asked around licensures for institutions engaging with and custodying digital assets, which I actually think is a nice summary point that intersects with multiple different considerations that Yehuda has raised around this discussion, which at the end of the day, the institutionalization or the institutional dynamic around custody is a perfect harmony of both security and compliance. We're building out robust control environments that mitigate traditional financial risks, but also integrate specific and technical considerations around the application of MPC or the application of cryptographic risks in this new business model. So at the end of the day, as we think about kind of the advancement of this institutional custody infrastructure layer, it really is the intersection of security, technology, and compliance that makes this all possible.
Wow. Okay. Thank you for that, Sal. Now, I see we have 5 minutes left. Do we have time for one more question?
Let me run through I see there are a few questions here. Let me just run through them. I think that I can do them in 5 minutes. I'll make the answers short. So, okay. First is, does Bitcoin scripting support MPC out of the box? It doesn't support MPC, it supports multi-sig. So 5 out of 8 signatures, yes, you can do, but it's very limited. I mentioned actually why it's limited earlier in the talk, so maybe you could take a look there. But multi-sig doesn't give you nearly the flexibility that MPC does. Second question, is there any central service or agent orchestrating the key shard exchange between all parties? The answer is no. Even at key generation, this is generated in a distributed way. So it's never in any single place at any time throughout the entire life cycle. There's what is Unbound doing to mitigate the social engineering aspect of custody solutions? And here again, by one of the advantages of the risk-based policies and that type of mechanism that is across multiple devices and servers is that even if you can trick a human being into approving a transaction, if the policy is not met, the human won't even be involved in it. And if you could somehow get the human to accept on their side, you have other servers and other humans who simultaneously have to do the same thing. That makes it very, very difficult. And again, the servers you cannot convince a server to not fulfill the policy. That just won't happen. How long does it take to make policy changes in key signing? Is a certain percentage of the key needed to approve the policy change? The answer here is that yes, you actually do. Well, how long does it take? It doesn't take very long. You can define administrator role, and a quorum of administrators just need to approve that. Now, depending on what you want, the quorum of administrators, this can be a separate set of roles, and you define whatever you might define, 3 out of 5 of those to distribute a policy. But you can also actually make the same quorum for changing the policy, the quorum for changing the policy be the same quorum of signing as well. And that's, I think, what you're alluding to in the second part of this question, a percentage of the key needed to approve. You can effectively make it that you would need to essentially be able to have the entire key or a full quorum of key signing to change a policy as well. Again, our platform enables you to define this however you want, and it depends on the business needs. And the final so the question is our solution deployed at financial institutions, and what are the most crucial learnings? So we are engaged in number of exchanges right now that have been deployed for a good amount of time, and we are working closely with other customers at building out custody solutions. Maybe actually, Sal, do you want to weigh in on what your crucial learnings? From our side, I think that what I presented is actually what we learned from them. We've learned a lot from our customers. But Sal, do you want to just finish off with what you think are the most important points here?
Yeah, absolutely. I mean, and just building on kind of that learning curve in terms of institutionalization, there's been a number of different approaches towards the stand-up of custody capabilities within that kind of tier 1 institutional landscape. Some folks have looked towards the third-party tech approach. Some folks have built internally. At the end of the day, there's often a challenge within those large institutional landscapes that looks at the integration and user experience around digital assets and how we take all these complex topics around security and technology and abstract them away from the user experience and create a seamless integration path of custody as a core capability, but within the broader core banking application landscape. So there's a number of different ways to solution for these problems, but ultimately that's a challenge that we see fairly consistently across the board in that large institutional space.
Okay. Thanks, Sal. Thanks, Yehuda. All right, it looks like we're running out of time. Thank you to our presenters today and to everyone who participated and for all of your questions. It's great to see how engaged you all were today. If you're still waiting on an answer, we look forward to being in touch with you. And just a reminder, it's on your screen now, but don't forget to take a look at the attachments and guides we're including. There's lots more information there, and you can review the slides. Lots of information to process, so feel free to download them. It's the attachment tabs on your screen. And thank you again so much, and have a great rest of your workday. Take care.
Thank you very much.
Thank you, Yehuda. Thank you, Tova.
Thank you.